People think you need tens of thousands of dollars to start investing seriously, but that's just not true. I'm here to tell you a secret that the majority of people in the personal finance space don't want you to know. There's an exact strategy used by ordinary people to turn $1,000 into $10,000, and then into $100,000. And get this, it works whether markets are up or down. This strategy is based on the power of compound interest, and I'm not just talking about any old compound interest. I'm talking about a specific type that's often overlooked by beginners, but has been used to create wealth for generations. It's called dollar cost averaging, and it's not as complicated as you might think. Dollar cost averaging is simply the practice of investing a fixed amount of money at regular intervals, regardless of the market conditions. This means that when the market goes up, you'll be buying in at higher prices, but when it goes down, you'll be buying in at lower prices. Over time, this strategy can lead to incredible returns. For example, let's say you invest $1,000 into a high-yield savings account with a 5% annual interest rate. In the first year, your investment will earn $50 in interest. In the second year, that same dollar will earn $52.50 in interest, because it's now earning 5% on top of itself. And in the third year, it will earn over $55. That may not seem like a lot, but trust me, it adds up. Take Warren Buffett, for instance. He's one of the most successful investors of all time, and his net worth is estimated to be over $90 billion. But did you know that he started out with just $100? He used dollar cost averaging to build his wealth over time, and now he's one of the richest people in the world. Now let's dive into the first section of our strategy, understanding the power of compounding. Compounding is a mathematical concept that shows how quickly your money can grow when you earn interest on top of itself. It's like a snowball rolling down a hill, gaining speed and size as it goes. And the best part? You don't need to be a math whiz to understand it. To illustrate this, let's look at an example from Dave Ramsey, a well-known personal finance expert. He once shared a story about how he invested $100 into a mutual fund that earned an average annual return of 10%. Within just 5 years, his investment had grown to over $2,300. That's not bad for a single investment. But here's the thing, it wasn't just the 10% interest rate that made his money grow, it was the compounding effect. Compounding is what allows your investments to grow exponentially over time. And it's not just limited to savings accounts or mutual funds. You can use dollar cost averaging with stocks, real estate, and even cryptocurrencies. The key is to start small, be consistent, and let time work in your favor. Now that we've covered the basics of compounding, let's move on to our second section, creating a solid investment plan. This is where many people get stuck, but it doesn't have to be complicated. You can use the 50/30/20 rule as a starting point. Allocate 50% of your income towards necessary expenses like rent and groceries, 30% towards discretionary spending like entertainment and hobbies, and 20% towards saving and investing. For instance, let's say you make $5,000 per month. Using the 50/30/20 rule, that would mean you'd have $1,000 left over for saving and investing. You can then use this money to invest in a diversified portfolio of stocks, bonds, or real estate. The key is to find an investment strategy that works for you and stick to it. One strategy that's gained popularity in recent years is the FIRE movement, financial independence, retire early. This involves aggressively saving and investing your money, often by living below your means and cutting expenses. By doing so, you can reach financial independence much faster than you would through traditional means. For example, let's say you're 25 years old and want to retire at 55. Using a FIRE-style investment plan, you could potentially save over $1 million in just 30 years. That may seem like an unrealistic goal, but it's not impossible with the right strategy and discipline. Now that we've covered creating a solid investment plan, let's move on to our third section, understanding risk management. This is where many people get scared off from investing, but it doesn't have to be complicated. You can use the concept of dollar cost averaging to mitigate your risks and achieve steady returns over time. For instance, let's say you invest $1,000 into a stock that earns an average annual return of 15%. But then the market takes a downturn, and the value of your investment drops by 30%. If you're using dollar cost averaging, you'll be buying in at lower prices when the market goes down, which means your overall returns will still be higher. One strategy for managing risk is to diversify your investments. This involves spreading your money across different asset classes, such as stocks, bonds, and real estate. By doing so, you can reduce your exposure to any one particular investment and achieve a more stable return over time. For example, let's say you invest $1,000 into a stock that earns an average annual return of 10%. But then you add another $500 into a bond that earns an average annual return of 5%. By diversifying your investments, you can reduce your overall risk and achieve a more stable return. Now that we've covered risk management, let's move on to our fourth section, understanding taxes and fees. This is where many people get bogged down in the details, but it doesn't have to be complicated. You can use tax-advantaged accounts like 401(k)s or IRAs to reduce your tax liability and keep more of your hard-earned money. For instance, let's say you invest $1,000 into a taxable brokerage account that earns an average annual return of 10%. But then you move it into a tax-advantaged 401(k) account, which reduces your tax liability by 20%. By using tax-advantaged accounts, you can keep more of your money and achieve a higher return over time. One strategy for minimizing taxes is to use the power of tax loss harvesting. This involves selling investments that have lost value in order to offset gains from other investments. By doing so, you can reduce your tax liability and keep more of your hard-earned money. For example, let's say you invest $1,000 into a stock that loses value by 20%. But then you sell it and use the loss to offset gains from another investment. By using tax loss harvesting, you can reduce your tax liability and achieve a higher return over time. Finally, let's move on to our fifth section, creating a long-term plan for wealth creation. This is where many people get stuck, but it doesn't have to be complicated. You can use the concept of dollar cost averaging to create a steady stream of income over time. For instance, let's say you invest $1,000 into a high-yield savings account that earns an average annual return of 5%. But then you add another $500 per month into a diversified portfolio of stocks and bonds. By using dollar cost averaging, you can create a steady stream of income over time. One strategy for creating long-term wealth is to use the power of compound interest. This involves investing money at regular intervals, allowing it to grow exponentially over time. By doing so, you can achieve incredible returns that far exceed what you could have earned through traditional means. For example, let's say you invest $1,000 into a mutual fund that earns an average annual return of 10%. But then you add another $500 per month into the same investment. After just 5 years, your investment will have grown to over $25,000. And after 10 years, it will have grown to over $100,000. In conclusion, turning $1,000 into $10,000, and then into $100,000, is not as complicated as you might think. It's all about using the right strategy, being consistent, and letting time work in your favor. By using dollar cost averaging, understanding compounding, creating a solid investment plan, managing risk, and minimizing taxes and fees, you can achieve incredible returns over time. So don't be intimidated by the idea of investing. Remember that it's not about how much money you start with, it's about the strategy you use to grow your wealth. And most importantly, stay consistent and patient, because that's where the magic happens.